Short exercise 6-3, specific identification inventory costing. So in this problem, we're going to be keeping track of our inventory using the specific identification method. The specific identification method means when you sell an item, you know exactly which item was sold. For example, a car dealership can use this system. A car dealership knows which car they sold because each car has a VIN number. Now, most products that companies sell do not have specific identification numbers. So this specific identification method is not very common. However, it's the easiest of the 4 different methods we're going to learn. So we're going to start with it. The other methods, if you're curious, are called FIFO, first in, first out, LIFO, last in, first out, and then the weighted average method. So let's start with the specific identification inventory costing method. So Montana Cycles started July with 25 bicycles that cost $36 each. On July 16th, Montana bought 35 bicycles at $60 each. Notice the prices are changing. They were $36 and now they're $60. And then later, the company sold bicycles for $105. We have to use this record to keep track of our inventory. We'll keep track of the purchases, the units that we sold, and then how many units are on hand after the purchase or after the sale. So requirements: prepare Montana Cycles perpetual inventory record, assuming the company uses the specific identification costing method. Assume they sold 20 bicycles that cost $36 each and 13 bicycles that cost $60 each. And then we're going to journalize the purchase and then journalize the sale. Start by entering the beginning inventory balances. Enter the transactions in chronological order, that means by date, calculating new inventory on hand balances after each transaction. So in other words, after we purchase some, we have to figure out, well, what's the different prices that we bought them at and what's the total cost of them. And then once all the transactions have been entered into the perpetual record, calculate the quantity and total cost of inventory purchased, sold, and on hand at the end of the period. Enter the oldest inventory layers first. Now, when they're talking about inventory layer, they means different costs. So if we bought some inventory at $36, and then later we bought some at $60 each, those are 2 different layers or 2 different costs for the inventory. Abbreviations used: QTY is quantity, TOT is total. So what they wanted us to do first, it says start by entering the beginning inventory balance. So let's go back up here. The company started July with 25 bicycles that cost $36 each. So here's our inventory on hand columns. So we're going to input 25 bicycles. We're going to tab over 36, and then we need the total cost. So that's going to be 25 times 36 equals $900. So what this means is on July 1st, they had 25 bicycles that cost them $36 each, and the total cost is $900. Now, what happened on July 16th? So we know we're working on July 16th because it has the date here. So we go back up here to find our details. On July 16th, Montana bought 35 bicycles at $60 each. So we're buying bicycles. So where do we put them in? Purchases, cost of goods sold, or inventory on hand? Well, we purchased these, so we're going to have to put the 35 bicycles at $60 each under purchases. Quantity 35, 60. So the total cost is 35 times 60 equals $2,100. Now we have to fill in our inventory. So notice back on July, we had 25 bicycles that cost us $36 each. We need to bring those down first. So we haven't sold any. How do we know we didn't sell any? Well, because the transaction was we purchased more. So we're going to have to list our 25 at 36 for $900. And now we have to bring down this new layer of inventory and list it here. So we have 35 bicycles that we just bought, cost 60 bucks each, $2,100 worth. So now if our boss asked us on July 16th, how many bicycles do we have? We have 25 plus 35, so we have 60 bicycles. And how much did they cost us total? 900 plus 2,100 gives us $3,000. We don't have to add those up, but if your boss asked you that, that's what you would tell her. Now, what's happening on July 31st? It says on July 31st, Montana sold 33 bicycles, and we're charging $105 each. Now, that's what we're charging our customer. This table here is only about our cost, so we're going to have to look elsewhere in here to see how much it cost us. Which bicycles did we sell? We're trying to figure out, of those 33 bicycles we sold, how many were at this $36 cost to us, and how many were at the $60 cost to us. Now, because this company uses specific identification, they would have to know exactly which layers of inventory these bicycles came from. And they apparently do, because that's why they're using specific identification. So here's the details we're looking for. Assume that Montana sold 20 bicycles that cost $36 each. So out of this $36 layer, we had 25, but we sold 20 of those. So we're going to put 20 times 36. So I just bringing this $36 down here. Where did I get the 20? The 20 comes from right here. Okay. And then, now remember, back up here, it says on July 31st, we sold 33 total. Notice we're doing July 31st here. And if we're selling 33 total, that means we need another 13. And it tells us that right here. We did not have to do the math. I'm just showing you how that works. We sold 13 bicycles that cost $60. So from this layer here, the $60 layer, we had 35 of them. We sold 13 of them at 60. So I'm just bringing this 60 down here. And now I have to figure out the cost. So let's see, 20 times 36 is 720. And see, 13 times 60, that's 780. So our cost of goods sold, notice this is our cost of goods sold column, for this July 31st sale is 720 plus 780. Now, notice we have to go back to our inventory on hand columns and update our inventory. So before this, now remember, we bring down the oldest layer first. So we have to bring down our $36 layers and then our $60 layer. So let's work with a $36 layer. We had 25 quantity-wise on July 16th. And then July 31st, we sold 20. So if we had 25 and we sold 20, how many do we have left over? 25 minus 20 is 5. And now let's work on this $60 layer. If we had 35 back on July 16th, but we sold 13, how many do we have left over at that $60 level? So 35 minus 13 gives us 22 units left. So now we have to figure out how much they cost us for our remaining inventory. 36 times 5 is 180. And then we're going to do 22 times 60 gives us 1320. So now let's talk about this inventory on hand group of columns. So this $900 here means that only on July 1st, July 1st only, we had $900 of inventory. On July 16th, how much inventory do we have total cost-wise? $900 plus $2,100, so $3,000. Now on July 31st, what's our inventory that we have left over? $180 plus $1,320. Remember, this is our cost, the cost to us. Now we need our totals. So let's just work on our purchases column. What's the quantity of purchases that we had? Well, the only thing in here is 35, so we're going to bring that down. And since that was our only purchase, the total cost was $2,100. Now we're looking at our cost of goods sold column. What's the quantity of bicycles that we sold? We sold 20 plus 13, which, notice, has to match this up here where it says we sold 33 bicycles. So we sold 33. And what was the total cost to us of those bicycles? $780 plus $720. So 7 plus 7 is $1,400 plus 100. So that's $1,500. So our cost of goods sold for this sale on July 31st is $1,500. Now, how much inventory do we have left over? We have to look at just this last date. We can't go up here to the July 1st or the July 16th because that's past history. We have to look at our last updated inventory. We had 22 at one layer of cost, and we had 5. So we add those together. So we got 27 bicycles. And how much did they cost us? $180 plus $1,320 is what? That's $1,500. So if your boss asked us at the end of the month, how many bicycles do we have left? 27. How much did they cost us? $1,500. And if your boss asked us how many bicycles did we sell this month? 33. What's the cost of our goods sold? Well, those 33 bicycles cost us $1,500 total. How many bicycles did we purchase? 35, and they cost us $2,100. All right. So we have this inventory table of Montana bicycles completed for the month. Now what we're doing, it says journalize the July 16th purchase of inventory on account. So we're going to do the purchase of inventory on account. So let's go back up to July 16th. Here's our purchases. So we have to journalize this transaction. So in the journal, do we keep track of quantity or dollars? We keep track of dollars. So we have to use the $2,100. So on that date, our inventory is going up. Inventory is an asset, and assets go up on the left side, the debit side, so that's why I put it as the debit. So now we need a $2,100 credit. So did we pay cash, and this would be cash going down, or did we buy it on account? We bought it on account, so that's accounts payable, and we have more debt, and which means liabilities, and liabilities increase on the credit side. So that's why I'm crediting AP. And then we need an explanation, purchased inventory on account. Now, it says July 31st. We need to record the sale of inventory on account. Begin by preparing the entry to journalize the sale portion of the transaction. In other words, either cash or AR is what we're receiving, and then we have to record our revenue. Do not record the expenses related to the sale. We will do that in the following step. Assume that Montana sold the bicycles for $105 each. So we need more details than just how much it cost or how much we're charging. So we need to go back up here. It says on July 31st, Montana sold 33 bicycles for $105. So let's see how much is our total sales. 33 times 105 equals $34.65. All right, so did we get cash or are we getting AR for this? it says we sold it on account, so we have to record AR. We are not getting cash yet. AR is an asset, and we have more accounts receivable, therefore assets are going up. And assets, of course, increase on the debit side. That is why I'm debiting the $34.65. Now we need to record our sales revenue. Sales revenue is increasing, and revenue increases on the credit side. And if you forgot where we're getting these pluses and minuses from, we're getting them from our accounting equation. Assets, the AR, increases on the left side, and sales revenue increases on the right side. And for the previous transaction, inventory, an asset, is increasing, so that's why we debited inventory here. And liabilities, AP, increases on the right side. Now we need an explanation to record sale on account. And now, journalize the expense related to the July 31st sale. Review the perpetual inventory record you prepared in requirement 1. So if this is not a test, then My Accounting Lab lets you click here so you can see our inventory record. If this was a test, you'd have to scroll up. So now we need to record the expense related to the sale. So when we have a sale of an inventory item, what is that expense called? Cost of goods sold. And remember, since cost of goods sold is an expense, this expense is increasing, which is why we're using the debit side. Now, using our table, where does it show our cost of goods sold for the July 31st sale? Well, here's July 31st, and we have two numbers for cost of goods sold. We have to add those numbers up, which turns out to be $1,500. Now, one last thing we have to adjust. What happens to inventory when we sell some of it? Inventory is going down. Inventory is an asset, so how do we make that inventory go down? We need to credit it. So inventory is going down, and then this is to record cost of goods sold. So remember, whenever you have a sale of a product, an item, as opposed to a service, you're going to have two transactions. This one is what we're charging our customer, and we got that data from up here. This tells us how much we're charging our customer. And the second one is showing our costs. And how do we find our costs of inventory? We have to go back to the inventory table. And it shows our cost of goods sold right here. And that's it.